Let's jump right into this explainer and unpack what is basically the ultimate business scorecard: financial reporting. Whether you're looking at a huge, fast-growing athletic brand or just a local independent shop down the street, getting a grip on these core numbers is absolutely crucial. It's literally the key to unlocking how a business is actually performing behind the scenes.
So here's our roadmap for today. We'll start by decoding financial statements, then tackle Task 1 on analyzing gearing risk, move on to Task 2 for calculating ROCE, look at trends and context, and wrap up with Task 3 on reporting limitations.
All right, let's kick things off with Part 1, decoding financial statements.
The first thing to notice here is how we clearly separate the day-to-day operational performance from the overall worth of the business. On one hand, we've got the income statement, which is all about tracking revenues, expenses, and profits. And then, on the other hand, we have the statement of financial position, which you've probably heard called the balance sheet. And that details the assets, liabilities, and shareholder equity.
Now, the really crucial point is how these two interact with time. The best way to think about it is like this. The income statement acts kind of like a video recording of the year's trading performance over a set period. But the statement of financial position, that's just a single photograph. It captures the health of the business on one specific day, telling you exactly what is owned and what is owed at that exact moment.
Moving right along to Section 2, let's dive into Task 1, analyzing gearing risk.
So gearing essentially tells us who really owns the business. Is it the shareholders or is it the banks? It measures how much a company relies on long-term debt to finance its operations. To find it, you just take your non-current liabilities, divide that by total capital employed, and multiply the whole thing by 100. Okay, put on your analyst hats for a second. For our AO3 analysis task, I want you to consider this scenario. What happens to a company's financial risk profile if they decide to take on a massive bank loan to completely upgrade their inventory tech? Imagine calculating the new ratio after that massive influx of debt, and you're staring down a bold 65% gearing figure. Think about that. That means 65% of the capital tied up in the business is borrowed. And this brilliantly illustrates the double-edged sword of debt, right? Because while that shiny new inventory system might seriously improve daily operations, the heavy debt burden elevates the financial risk big time. The business is now highly reliant on external funding, they're super vulnerable to interest rate hikes, and they're stuck with these fixed repayment obligations, even if sales suddenly drop off a cliff.
All right, let's pivot to Section 3, Task 2, calculating ROCE.
Return on capital employed, or ROCE. Similar to your standard ROI, this formula is essentially the gold standard for measuring how efficiently a management team uses the resources they're given to generate profit. You just divide your operating profit by your capital employed, which, remember, is equity plus non-current liabilities, and then multiply by 100.
Let's actually tackle our AO2 application task by breaking this calculation down into 3 really simple steps. First, grab your operating profit. Second, identify the capital employed. And third, just divide the first by the second and multiply by 100 to get your percentage. Easy, right? Now, using these provided figures straight from our source material, I want you to mentally run the numbers through our 3-step process. We have an operating profit of £330 million, which was generated from a capital employed of £3,000 million. Run that math, and it reveals a very solid 11% return on capital employed. But the math is only half the battle. Interpreting this result is vital. We can conclude here that the business is making really efficient use of its capital, turning a healthy profit from its core operations long before the taxman and the banks take their cut. It shows you exactly what's being generated for every single pound invested. A higher, consistent percentage like this, that makes a business incredibly attractive to potential investors.
Let's move to Section 4, Trends, Benchmarks, and Context.
Here's the thing. A ratio like an 11% ROCE, or any specific liquidity figure really, means absolutely nothing in a vacuum. We have to benchmark it against industry competitors. For instance, comparing an athletic wear brand like Gymshark against the wider UK clothing market average. If their liquidity is lower than that average, well, it might suggest a weak financial position.
But hold on, because this exact guidance straight from the official mark scheme reminds us of something super important. A company's specific strategy completely alters how we should interpret their financial data. Gymshark focuses on specialized sports clothing, not general everyday apparel. You can't just blindly assume their numbers should perfectly match the industry average. Context literally changes everything here.
Which brings us to our final part, Section 5, Task 3, Reporting Limitations.
For our final AO4 evaluation task, we really have to pull back the curtain and ask the big question. Do financial reports alone provide a sufficient basis for assessing a business's long-term competitiveness? Do these quantitative scores truly guarantee future success?
To answer that, we have to weigh the cold, hard mathematics on one side against the qualitative, human, and environmental realities on the other. Financial data gives us historic margins, sure, but it entirely misses non-financial factors, things like environmental, social, and governance reporting, or ESG, which are becoming absolutely massive right now.
The fundamental limitation of financial reporting is that it only looks backwards. It completely misses the human and environmental factors like a sudden drop in customer service, or poor employee morale, or a high carbon footprint that actually dictate future survival. Think about it. You could have great numbers today, but a toxic company culture will absolutely destroy those numbers tomorrow. So I'm going to leave you with a provocative thought to ponder. If financial statements only act as a rearview mirror telling us where a business has been, what metrics will you use to look through the windshield and measure where it's truly going? Because true business intelligence requires both the rigorous math and the broader context. Thanks for joining me for this explainer, and I'll catch you next time.